Okay, in this series of videos, we're going to take a look at Treasury securities and learn a little bit about these very important instruments in the bond world. The first thing we'll look at are some characteristics of Treasury securities that are really important to keep in mind. The first one is the minimal credit risk that investors in Treasuries faced. We've already talked about this in a previous video, where Treasuries are basically the benchmark in terms of a risk comparison. We look at the yields of Treasuries and the yields of comparable maturity corporate bonds or other bonds, and we can look at the difference in those yields, and that's going to be a spread, benchmark spread, because the benchmarks are these Treasury securities because they represent basically a risk-free security, risk-free in the sense of credit risk or default risk. The second aspect or characteristic of Treasuries that are really important is the very large volume that these securities have. There's a great deal of Treasuries that are sold on an ongoing basis. There's a vast amount of Treasuries that are outstanding. And that leads to this third bullet point here, that Treasuries are very liquid. It's very easy to buy and sell them. There's very tight spreads between a bid and an ask. The pricing is going to be very finely detailed. We're going to go out a number of decimal places when we talk about the prices. So it becomes very important to be precise in the calculations, precise in the measurement of pricing. Another important aspect, and one we've touched on in previous videos as well, is this idea of callability. There is no call option for the government to call back those Treasury securities. They are going to go all the way to maturity. They're going to be paying interest all the way until that maturity date. There's no call option available. And then the last thing here, the interest is taxable, but only at the federal level. If you're investing in Treasuries, you wouldn't pay any state income tax on that income, any local income tax. One little side note here, the interest on zero coupon bonds, there's an imputed interest, I should say. You're still paying taxes on imputed income, even if you have a zero coupon bond. So a bond that has no income along the way until the maturity, because you're buying it at a big discount, the U.S. government imputes an interest component. Basically, the march up in the value of that bond is called interest, and you're taxed on that increase in the value of the bond. So even zero coupon bonds are taxable. Well, let's move on to the next slide here and take a look at the different types of Treasuries. We've got three main categories. There's the T-bills. These are Treasury securities that have less than 1 year to maturity. There's Treasury notes. These are 1 to 10 years of maturity. And by the way, this is an important side note. This is the time to maturity from the issuance date. So not necessarily what it is today, but what it was when it was issued. So if the Treasury is issuing a 10-year security, it's going to be a note. If we're now 9.5 years into the life of that Treasury note that was issued 9.5 years ago, it's still a note that has a maturity now in 6 months. It doesn't change aspects as it's moving along a timeline. And then this last one here, Treasury bonds. These are the longest termed bonds, the longest term securities, I should say. They have 10 to 30 years term to maturity. There's a few other aspects that we could separate Treasuries into. One of them is fixed principal versus inflation indexed. We're going to look at an example here in a minute of inflation index bonds. Those are the Treasury inflation protected securities, the TIPS. So we'll look at that in much more detail. We could also split out Treasuries in terms of fixed rate versus floating rate. So most securities, most Treasuries are fixed rate bonds. That is, they have a set coupon rate that pays a set amount of interest every 6 months along the way. Floating rate bonds, these floating rate notes, the FRNs, they adjust the interest rate. So every quarter, the interest rate is being reset based on market conditions. There is an index, there's an underlying interest rate that's going to be reset based on market conditions, and then there could be a margin that is based on auction outcomes. So it's a margin that's set based on the market, and that margin would be over and above the underlying index. We're going to look much more closely at floating rate instruments in future chapters, future videos. So we're going to kind of gloss over that for now. But there is this aspect or this portion of Treasuries that are floating rate. Let's move on to look at Treasury inflation protected securities, these TIPS. These are fixed coupon instruments, so there's a fixed coupon rate that's determined by auction. Again, in the next video I think we're going to look more in detail at the auction process, how that would work. But we've got a fixed rate coupon, and what's going to happen with these TIPS is that the principal and the interest payments are going to adjust for inflation over time. So we've got an inflation protection built into the mechanism of this bond. So what happens is the investor will end up with a real return, that is an inflation adjusted return, that's equal to the coupon rate that was determined in the bidding process. So why don't we go to Excel and look at these securities and how they work. Okay, we've got an example here. This is a TIP security that has a $100,000 principal balance, an original principal balance. That is going to adjust, as we'll see here in a minute. We've got the coupon rate of 1.25%. That's determined in the bid process, and here we've got an assumed term to maturity of 4 years. So let's go through what's going to happen with this TIPS security, this TIPS bond. So the original principal, we just talked about this, is $100,000. That principal is going to adjust through time based on the inflation rate. So I've put it in some assumed inflation rates. I think I'm going to go ahead and create another video after this one that talks about where those inflation rates coming from, how we're going to look at them, how we need to think about them. But for now, let's just take these as the given interest rates, as the given inflation rates, and then use those to adjust the principal. So let's just do the first one here. We're starting with an original principal of $100,000. After 6 months, so at the end of period 1, again, these are semi-annual interest-paying bonds, just like the vast majority of bonds in the world, and that's how treasuries work as well. The vast majority of those are paying interest every 6 months. So we're going to adjust the principal for inflation after 6 months. Now this inflation rate, you can see it's denoted as an annual rate, so we need to adjust that inflation rate by half. We need to take half of that inflation rate and use, in this case, 1.25%. and grow our original principal balance by that 1.25%. That's what's happening with this formula. And so my result is $101,250. So you can see that in this case, it's really easy to see that's 1.25% bigger than the other one. Let's move forward to the next period. And so my new inflation rate for this next 6-month period, for this next window, is now at an annual rate of 2.75%. So again, I'm not using 2.75%, that's an annual rate. I need to use a 6-month rate. So in this case, I'm going to, again, take that annual rate, divide it by 2. And what's growing now is not the 100,000, but it's growing that previous adjusted amount of 101,250. We're just taking the 100,000 and we're going to be growing that consecutively through time. So after one period, the 100,000 has grown to here. This next period, we're going to grow the 101,250 by that new inflation rate. So again, the inflation rate for period 2 adjusted for the fact that it's only 6 months. So the same thing for period 3 through period 8. We're just going to grow the previous adjusted principal by half of the inflation rate. So if we follow that formula all the way down, we're going to end up with this very last principal amount of $112,122. That would be the amount that's going to be due at maturity, the amount that the government would pay in an adjusted principal balance. That's the final check, or the final face value payment. The face value is going to be adjusted a long time. The coupon payment is going to be based on the adjusted principal balance, and then we're going to just pay the coupon rate of 1.25%. So remember that coupon payments are always going to be equal to the coupon rate times the principal balance. And in this case, since they're happening every 6 months, we're going to divide that result by 2. So that's what my formula here is doing. So my very first coupon payment is going to be $632.81. After 6 more months, so at the end of the first year, my coupon payment is going to grow to $641.51. And by the way, that's going to grow by the inflation rate. It's going to be half of 2.75% bigger than this one was. So our coupon payments are adjusting for inflation, as well as our principal amount outstanding. So each period is going to grow in terms of the coupon payments. So the very last one is going to be equal to $700.77. If I look at the net cash flows from investing in this bond, we can track and see where those are coming from. My initial investment is $100,000. My very first cash flow after 6 months is this coupon payment we just calculated. And if I go all the way down to this very last cash flow, it's going to be equal to the outstanding principal balance plus the coupon payment. So my total cash flow at the end of 4 years, at the end of the 8th period, is going to be $112,823. I can look at what my yield is, my nominal yield, that is not adjusted for inflation, and that would be a 4.15% return. So that's my total return, that's my nominal return. Remember that these tips are really about inflation protection. So what I want to do is look over here and get a sense of what my real cash flows are. So I want to talk through the calculation real quick. I've got an inflation factor, and this is a little bit of a painful calculation. We might go through how to do that in the next video, how to come up with something along these lines. But this number is basically taking into account the inflation that has happened since the beginning of this bond. So after 6 months, we've got an inflation factor of 1.25%. At the end of the first year, at the end of the first 2 periods, I've got really an effective inflation rate of 2.64219%. And that's going to keep growing based on all of the inflation that has been happening over the life of this bond. So by the end of it, the total inflation is 12.122%, and you can see that our outstanding principal balance is indeed 12.122% bigger than the original principal balance. So if I adjust all of my cash flows, these nominal cash flows, if I adjust those for this inflation factor, I end up with some real cash flows. My time period 0 is obviously the same amount, but they're gonna change through time. Actually, they're going to be adjusted through time and remain the same on a real basis. So every cash flow is real, a real amount of $625. And if I go down and take the IRR of that set of real cash flows, my inflation adjusted IRR, or my real return, inflation adjusted return, is the 1.25%. And you can see that that's the exact same thing as my coupon rate. So I'm going to stop here. We're going to come back to this screen in the next video, and I want to look a little bit more closely at inflation, where we come up with those numbers, how we can do some of this inflation factor computation. I'll just show you kind of where we can come up with that. So we'll do that in the next video, and I'll see you then.